Good morning, everybody. It's just gone 9 o'clock on my clock, so I think it's best that we get started. There's quite a lot of information that we need to cover in this half an hour. So yes, but as we go along, please feel free to ask any questions that you might have in the Q&A section. If we don't get to them at the end, which we probably won't, but please, we'll definitely get those questions and get them to us, and we'll be able to respond via email if need be after the session. So yes, just a quick introduction. My name is Michael Steenkamp. For those who haven't met me before, I'm one of the directors in the audit department at RSM South Africa, and also the head of IFRS. So the things that we're wanting to cover just this morning are, firstly, I'm just going to spend 10 minutes quickly just recapping on where we've come from. So going through just a quick one-pager summary of IFRS 9, IFRS 15, and IFRS 16. Please, for those of you who these topics are still a little bit unfamiliar to you and they're not quite sure about the accounting and that, there are webinars on these topics already on our social media and YouTube page. So please go find those if you do want a little bit more detail, but I'm also happy to have a discussion if need be. Then I'm just going to move on to just where we are now, what has changed recently, what other new standards are there, and also just things that are around the corner and what is currently in the pipeline at the IASB. So yes, so just getting straight into it then, IFRS 9, that was the first of the three big changes that we've had in the last 2 or 3 years. In the accounting, it's been a frenzy, I think, for a lot of us, getting into touch and getting to understand IFRS 9 and IFRS 15 and IFRS 16. So and we've dealt with it. It's a year now, or 2 years, I would say, into implementation of IFRS 9 and IFRS 15, and we a year down with IFRS 16. So I just thought, let's just recap where we've been and kind of what's happened with those. So IFRS 9 introduced new measurement basis. I think it was a lot easier than what was available under IAS 39. So pretty much for financial assets, we got away with that held for sale, available, held for trading, available for sale, loans and receivables, all those categories that we had to guess where we place the financial assets. They've simplified it a lot. We've got amortized cost, we've got fair value through profit and loss, and we had fair value through comprehensive income. Liabilities pretty much stayed the same, and those were at amortized cost or at fair value through profit and loss. The big change to all of us was the new impairment model. We were all used to an incurred loss model under IAS 39, which we always used to refer to as our provision for bad debts. And then there we recognize losses and recognize them when an event occurred, and only at that point. IFRS 9 came along and gave us this idea called the expected credit loss model. And what that meant, and in calculating the expected credit loss model, it gave us 3 options. It gave us the general approach, the simplified approach, and then the credit adjusted effective interest rates approach. So the one I'm just going to quickly touch on is the simplified approach, because in truth, that is the one that affects every single one of us. And we all deal with it, no matter what business you're in, you've got to deal with the simplified approach in calculating your expected credit loss. So what is it? It's the simplified approach is a mandatory application for this approach to any trade receivables as a result from a transaction within the scope of IFRS 15. That's the revenue standard that does not contain a significant financing component. So your typical sales transaction that you give terms to, your short-term terms to your customers, that would then fall into this category, and you would then have to use the simplified approach in calculating the expected credit loss. The loss is recognized on the total expected loss, so it's a future-looking thing. You've got to take into account probabilities and possible default events that might occur over the lifetime of that financial asset. So in truth, even if you've got an age analysis at year end and you've got assets in current, you've got assets in 30 days, in 60 days, and your terms might be 90 days, historically, we wouldn't have provided for any of those that aren't old or long overdue. What IFRS 9 requires us to do is to recognize losses for even those amounts that aren't past due, because there is a probability of default within those amounts as time passes by. So that was just IFRS 9, and that's pretty much what we dealt with there. The next one that was upon us was IFRS 15. IFRS 15 is the new revenue standard. It replaced quite a few standards that were around. There was IFRS 11, for example. Construction contracts was IS 18. That was the old revenue standard that we knew. So the IFRS 15 came along and really introduced a whole lot of new standards, replaced a whole lot of standards, sorry. And the need for this really was as transactions have gotten more complex in recent times, and over time, revenue standard had remained relatively unchanged. So there was definitely a need to relook at the revenue standard and how to account for these complex transactions. So what IFRS 15 brought along was the introduction of the 5-step principle, as we so call it, in recognizing a revenue from customers. The first step was simply to identify the contract with the customer. Step 2 was to identify the performance obligations within the contract. Remember, there could be more than one. It could be one in a simple transaction. There's one performance obligation, but however, there could be more. Think of a cell phone contract, for example, where you get a free handset normally when you take a cell phone subscription out. So there you're getting free data, you're getting the use of the network, you're getting the handset, but you pay one subscription price. Then you've got to determine the transaction price. And then once you've done that, you've got to allocate that transaction price to the different performance obligations in the contract. There might be standalone, there might not be, there might be discounts to one or more performance obligations, but not all of them. So those are things that you've got to take into account there. And then finally, step 5 is quite easy. Is then now you've got to determine, once you've satisfied the performance obligation, you either recognize your revenue at a point in time or over time. IFRS 15 came in again with this term control, and so the control with it in terms of step 5 is as soon as control has passed of the promised good or service, that's the point in time in which you would recognize your revenue. Control has been a concept that we've had many times before, and it's come in more and more standards recently. It's in IFRS 16, it's in IFRS 10, the consolidation standard, for example. So we are used to this term control now. So, but it is just something and what does that mean in terms of IFRS 15? So control of an asset transfers to when the ability to direct or obtain substantially all the remaining economic benefits from that asset. So that is when control passes. Control indicates the ability to prevent others as well from directing the use of that asset, obtaining the benefit from that asset. So that is when control passes in terms of IFRS 15. Then on to IFRS 16, which is the most recent one, and I think also another one along with IFRS 9, which have impacted most people and almost anybody who had an operating lease as a lessee, and we were expensing the lease payments every month, and we were straight lining them. IFRS 16 came along and threw a bit of a spanner in the works. IFRS 16, sorry, is applicable to anybody who is a lessee. Remember, this is specifically for lessees. It took away the old IAS 17 estimates on when we had to just determine whether it's an operating lease and go through the facts of the contract. Is that an operating lease or is that a finance lease? Now all leases are treated in the same way. Like I said, just remember that this is from a lessee point of view. So we had to measure a lease liability, and we did that by taking the lease payments over the lease term, and we would discount that at a discount rate. That is always the start of the calculation. Remember, is the lease liability, not the right of use asset. So the lease liability is the start of the calculation, and the opposite side would be the right of use asset. Your discount rate, if readily determinable, would be the rate implicit in the lease, but that is not. I've very rarely seen that to be the case. Otherwise, we need to calculate the lessee's incremental borrowing rate. Quickly, the incremental borrowing rate is the rate at which you could lend money at the same rate under the same conditions and the same terms to buy that asset outright. Payments could be fixed payments, they could be variable payments. That depends on, like, if sales, for example, specifically, like, for example, if they are dependent on sale or the use of the asset, then you would not include a variable payment. You could have optional payments, but if it's reasonably certain that would not occur, then you would not include those as well. So there is a little bit of calculations to go through as to whether or not whether or not payments within your lease are included or not. Typically, it's quite easy if you're renting a building or something like that. You just say fixed payments and it's so many years or so many terms, or over whatever lease term that you might have. Remember that your termination period will also be included if it is reasonably certain that you will apply that extension within when you determining what your lease term is. Then quite simply, what happens afterwards, we've got a rights of use asset, which we would treat like any other asset. We would depreciate it over through P&L and then and assess it for impairments. Your lease liability, similar to any other financial liability, you would unwind the interest each month through profit and loss, and obviously the liability will go down with the payments that you make. And then you would obviously have any lease reassessments of that lease liability, should there be changes in the lease term, for example, or changes in cash flows due to index for inflation, for example, something like that. Then you would just do a reassessment of that liability. There are two optional exemptions that were available under IFRS 16, and that was for short-term leases. So that's for leases that were less than 12 months, and then also for low-value assets. The guidance gave us a value of any asset that's got a value of less than $5,000. That'd be your laptop, telephones, things like that. You could also apply the low-value assets exemption, and you just treat those as you would have for an operating lease under IAS 17. Lessor accounting, like I said earlier, what I've just gone through now was specifically for lessees. This has remained pretty much unchanged. And for lessors and that you still go through the assessment, whether it's a finance lease or an operating lease, and you treat that pretty much as you always have, even under IAS 17. So that was just a quick overview on what's happened in the past. Like I said, there are, if you still have any questions, please feel free to contact us. But if there is other resources available on our social media platforms, as well as YouTube, on these topics, where you could get a little bit more detail as well. Okay, so now we're going to move on to where we are now, and the big drive at the moment is something that I thought it's important for us to share, be it, and this is really whether you are full IFRS or SMEs or whatever it might be. It's a big project at the moment, and that is looking at the disclosures in the financial statements and making those really more user friendly, more applicable, and things like that. So a big drive at the moment by the ISB is to bring out you'll see now we'll deal with the materiality, the new conceptual framework. There's a definition for materiality, not an audit materiality, but it's materiality applicable to disclosures in the financial statements. And there's also a new standard coming out on the presentation and disclosure of the financial statements, which we'll deal with as well later. So that's where the big drive is at the moment. I'm going to go through this quite quickly. And what I'm wanting to do is after this, I will send to all participants a bit of a more detailed summary of the conceptual framework and the new conceptual framework, because it's been the same, I think, for the last 30 years that we've had it. And now it has been updated. So I'm quickly going to go through what's been changed, but I will also send a detailed summary to participants, like I said, after sometime in the next week, just to give you a bit of a one-pager of what's changed and where we are now with that. So the concept, what is the conceptual framework? Some of us might know what it is. It's always that bit's right in the front of your textbooks, if you still have the old physical textbooks, and it really sets out what the fundamentals are and the fundamental concepts are in financial reporting, and guide the board when setting new standards. So obviously the first place we always go to is the actual standard in whatever area we might be dealing with, but it also helps us to ensure that the standards are conceptually consistent from one to the other, and sets out those criteria and how to recognize something, and that ensures that all transactions are treated in the same way. So that's pretty much what the conceptual framework. Remember that what the standard does say, though, that is if there is no specific standard dealing with your transaction specifically, that the conceptual framework is something that we need to go to then to figure out an accounting policy on how to deal with a specific transaction. So the purpose of the 2018, yes, it's 2018, so they did start this a while ago, revised conceptual framework, was really just to set out the objective of general purpose financial reporting, the qualitative characteristics for useful financial information. It sets out to describe what the reporting entity is and its boundary. It changed the definition of assets and liability that we all used to. It also brought in new criteria in recognizing and de-recognizing assets and liabilities. It updated the measurement basis for these as well, and sets out those measurement basis. And it also then gave us a more detailed concepts and guidance on presentation and disclosure. So that's pretty much what the purpose of it was. What's new, typically, there are some new things. So the concepts of measurement, including factors that when selecting a measurement basis. So that is new. That's been added on how you measure certain items. And guidance on that. It's given you, like I said, as the big thing is the presentation and disclosure and concepts on presentation and disclosure, and clarified, for example, income and expenses and where they go to, and those that are in other comprehensive income or not. And then guidance also then in derecognising assets and liabilities from the financial statement. So those are the new things that they've added, things that have been updated. They've updated the definition of an asset liability. I think we all knew the old, even from school days, of what the definition of asset liability was. That has been updated. And also then it's given us updated the recognition criteria of when to include assets and liabilities into the financial statements. What's been clarified, we all obviously know all these concepts that are there in the standard: prudence, stewardship, measurement, uncertainty, substance over form. We are all familiar with those terms and those requirements for proper disclosure in the financial statements. So also then, okay, so what the effective date of the new conceptual framework was for annual periods beginning on or after 1 January 2020. So it is effective from the beginning of last year already. So if you are busy dealing with your December 2020 year ends, it is, or Feb 2021 year ends maybe, it is an effective standard already. Like I said, but it is just there for guidance in setting standards. It's not going to change too much if you, of your financial statements or any accounting or things like that, but it is, just know that it is already effective. Then, like I said, so moving on from the conceptual framework, it's a good point now to move into what the new disclosure requirements are and where we're going with this, and better communication to stakeholders in financial reporting. So what's changed? So pretty much we've had an amendment to IS 1 and IS 8, which is a definition of materiality. So remember I said it's a definition from a financial statement disclosure point of view, not a audit point of view. We had a materiality practice statement which got released. We had IS 1 was amended to remove the barrier of application for judgment in disclosures. There was an amendment to IS 7, which is the cash flow standard, on disclosures of changes in liability in financing activities, and then also the exposure draft that I spoke about, which is a new standard out there on presentation of financial statements. So there's a lot you can see that's around disclosure and disclosure initiatives, and improving the financial statements and making them user-friendly. So the principles of effective communication is why they wanted to do it, and they wanted to make financial statements entity specific, and for us to get away from using the boilerplate standard copy paste from the disclosure tools that we might be using. They also want to make it simple and direct. They want financial statements to be big and organized. They want the information in the financial statements to be better linked. Better organized also means that you might have your accounting policies and your note and an explanation of that section all together in one place. No, you don't have to have 20 pages of accounting policies that nobody reads, and then you have the notes thereafter. You could group things all together. You could organize it like that if you find that beneficial. And better formatting of the financial statements, and then also free from duplication, so removing any duplication that there might be, which could obscure the information, and then also to enhance comparability across industries and companies. So that's pretty much the principles of effective communication that they're looking at and they want financial statements to be, and that's the reason for all of this. The definition of materiality is information is material if omitted, misstatement, or obscuring. It could reasonably be expected to influence decisions that the primary users of those financial statements could make. Omitting, misstating, or obscuring, it could be either you have too much information, you could have too little information. So they do say that even by putting too much information, you could be obscuring those financial statements or trying to hide something. So there is a line to find that what's too much or too little, and you need to find the middle ground of what's the right information to disclose based on those principles that we spoke about on the previous slide in disclosures of your financial statements. So materiality depends on the nature or magnitude of the information, or both. So you need to look at it from the financial statements taken as a whole when looking at materiality in the context of the financial statements. The three aspects to look at, obviously, that I spoke about already in the definition, that is what's obscure, what information might be obscuring, and whether or not either by omitting it or by putting it in, are you obscuring information in the financial statements? Who are the primary users, and what are their needs with regard to your financial statements? and then considering in whether or not it could reasonably affect to influence the users if you had to omit that information. So you've got to go through this thought process when putting in disclosures in the financial statement. So we need to move away from just switching things on because we think more is better. That's definitely not the case. So we need to relook at what's been included in our financial statements and how we are going to address these things going forward. And so it might be a big project, and it's rather something to start early on in reformatting, reorganizing, putting in the relevant information into your financial statements. The effective date also similar to the conceptual framework of this of the practice statement. It's not a standard, but it was a practice statement. Was for January 2020 again. So it's for your current year ends that you might be able to do without it, but December 2020 or February 2021 or whatever it might be. Please just bear this in mind, and please appeal that. Let's look at our financial statements. Let's make them specific. Let's follow those principles of effective communication, and take out the irrelevance in the financial statements and put what relevant that explains your business specifically. I know it is difficult with some of the tools that we might be using in preparing financial statements, but I think it's definitely a worthwhile thing to do, to sit down and make it specific, because I think the users will get a lot more value out of the financial statements. So then what's next? There's like I said, there's the general presentation and disclosures exposure draft that's out at the moment, that is out there in the market. It's an exposure draft, includes the proposal of the ISB, which is the International Accounting Standards Board, to improve how information is communicated in financial statements, with a focus on information about the performance. That's where the main focus is disclosing information in the statements of profit and loss, but there are also limited changes in the statements of cash flow and the statements of financial position. So just for interest's sake, so one of the things I've seen, for example, is they're looking at restructuring the statements of profit and loss, to be similar to what the cash flow is. So to split it between operating activities, financing activities, and investing activities. So it's not all your expenses or income. It's not all going to be lumped together now. So if you have any income, maybe interest, for example, or finance costs from financing activities, or interest or income from investing activities, those will all be disclosed separately now in those categories, similar to as we disclose in a cash flow. So that is the kind of idea they're doing it, but there's a lot more to it than that. But as you can see there, the effect of that, there is no current effective date for this due to COVID-19. The comments that were due by June 2020 last year, they've extended to September 2020 last year. So those comments were all submitted by September last year. So they're obviously going to go through those now, and the ISB will then issue a standard for us to go through and to approve and hopefully give us some sort of effective date into the future. I will definitely, I think because it's such a hot topic, I will definitely set up a webinar to be able to go through this in more detail in the future, and go through the actual changes to that and to disclosure, the disclosure initiative, and what is required by those practice notes and how things are going to change. So we will definitely set up another webinar dealing with only that in the future once we know what's going on. So just be aware at the moment that with all the disclosures and the materiality statement, that this is a big thing that's being looked at, improving the disclosures in the financial statements. Just a couple, we've got 5 minutes left, and just a couple of other matters that I just want to bring to your attention. Those are really matters that I just wanted to highlight. I thought it's important while I do have the participants online, that let me just highlight, and it's stuff to think about in what's happening, because I know a lot of us, the first one I wanted to deal with was IFRS for SMEs. A lot of our clients actually deal with IFRS for SMEs. We have a lot more on IFRS for SMEs than we do on full IFRS. So as we all know, that when they initially issued the first IFRS for SME standard in 2008, I think it was, they said that they would try not update the standard for a period of 3 years, and so to give users time to get into it and to use it consistently without all the changes that IFRS does have. So, and then so as we know in practice, 3 years turned out to be 6 years, because the next one was issued in 2015. And again, 3 years later, now we are 6 years later again, and we still don't have a new standard. But there is one, they started the second comprehensive review in October 2018. So it is hot on the topic at the moment. I do regularly try to get hold of the agenda from the meeting of the SME board, standard setters board, and committee. And I just wanted to say that for those of you who are on SMEs, that on the topic, on the agenda is definitely the alignment with IFRS. There's a lot more, but I just thought I'd highlight these because it's the requirement of the alignment with IFRS 9, IFRS 15, and IFRS 16, which I think we've kind of been ignoring to a degree if we've been on SMEs because we're thinking, oh, it's not applicable to us. So that's why if participants on this call thought the first 10 minutes weren't worthwhile because they apply IFRS for SMEs, it might be worthwhile for you guys also go get those recordings that we've previously done on these topics and just get an idea of those. And they will never ever be as stringent as full IFRS requirements. For example, IFRS 9, I know they're dealing specifically with the simplified approach in calculating an expected credit loss, and it will be easier. And I'm sure the disclosure will be a lot less as well. But I did want to just bring this to your attention that these things are happening. There is some sort of alignment. It won't be as difficult, like I said, and the disclosure requirements will probably be a lot less as we are used to under IFRS for SMEs. But I think the time of us under SMEs for ignoring these topics to a large degree is gone, and I think we need to have a bit of an idea of what's going on in those standards. When they do issue the new standard, we do know then what is required. So, but like I said, the same as for the disclosure standard that we're still waiting for. As soon as the new SME standard does get released, I will set up another webinar. We'll do this again and we'll go through the changes in more detail. But I just thought it would be very worthwhile just to get you guys all into the know of what's happening and that we should be expecting this in the very near future. Another thing that I just wanted to bring to your attention, and unfortunately it is a bit of a gray area and uncertainty in the market at the moment. But I just thought it'd be an important thing for you guys to discuss with your auditors or preparers of your financial statements or whatever it might be, in just whether or not they believe there is an impact or not. And that is the change in tax rates. As you know, the budget speech that happened towards the end of February, there was proposed to change the tax rate for corporate income tax only from 1 April 2020. So that was the first oddity, because normally we're used to it being that same year. To reduce that tax rate from 28 to 27. So IAS 12, which is the income tax standard, requires us to calculate deferred tax using the rate that is enacted or substantially acted at year end, for example. So if you've got a Feb 2021 year end, the big debate at the moment is whether or not, based on the budget speech at the end of Feb, that rate is substantially enacted or not. There are different views. I know SACA is busy looking at it at the moment as well, as to what our view on this is, but I just thought it would be an idea just to bring to your attention, something to consider, that it's real, it's here upon us. So I think it's a good thing to take note of, because especially those with investment properties or long-term deferred tax, for example, that will only be realized in many years to come. Like I said, if you've got investment properties, a prime example, you might be having to calculate your deferred tax on a different rate for your Feb 21 year ends going forward. But like I said, there is a lot of uncertainty at the moment. There's a lot of gray area. There are a lot of differing views on this, but maybe just chat to your preparers or your consultants or your auditors or us, and we can kind of find an answer together. So that really does come to the end of the presentation. I did say in this half an hour, there's a lot to go through. But just to recap, please, on the old stuff, go find it on our on our YouTube channel or social media or whatever. I will be sending out a summary on the conceptual framework, and I will then definitely also, as the disclosure standard comes out, or the SME standard, be doing webinars again, just to fill you guys in of what's happening there and what that's all about. So in this half an hour, I know it's been short, but thank you very much for your time and your attention. We always enjoy doing this with our clients and people that follow us out there. So thank you very much. And once again, enjoy the rest of your day. Goodbye.